Welcome back to the Daily Crypto Roundup. If you're listening right now, take 2 seconds, hit follow, and drop a 5-star rating. It helps independent crypto coverage get heard, and it keeps this show turning up in more feeds. Let's open the curtain. The market's breathing hard today. Headlines hit. Risk-off rejoined the party, and volatility is back in the driver's seat. We'll do the numbers first, then walk through 4 major stories. The slide in Bitcoin and Ethereum driven by new US-China tension, the massive DOJ Bitcoin seizure tied to a Cambodian scam, the UK's move toward restitution using seized crypto, and a pivot in SEC enforcement focus. Stick with me. We'll close with what you need to watch next. Let's set the table with the scoreboard. No stablecoins, just the movers. Bitcoin is trading around $111,276, off just under 2% on the session, with an intraday range between $110,292 and $113,538. ETH is near $4,003, down a little over 3% today after bouncing between $3,937 and $4,203. BNB is about $1,166, down nearly 5% intraday. Solana is roughly $198, off just over 3%. XRP is $2.44, also down a touch over 3%. Cardano sits around 67.4 cents, down just over 4%. Dogecoin is 19.8 cents, down about 3%. Tron is 31.6 cents, a mild slip. Chainlink trades near $18.14, down about 5%. Avalanche is $21.96, down just over 4%. In other words, red on the board, but not panic red. More like a heavy risk-off lean with a few buyers stepping in at the edges. And just as traders were catching their breath, the US-China tariff war reignited. And it hit the crypto markets almost instantly. Overnight, Washington announced a new wave of tariff reviews targeting Chinese tech and industrial imports, while Beijing responded by tightening export controls on critical minerals used in semiconductors and batteries. It's the same tit-for-tat dynamic we've seen before, but this time it landed right as Bitcoin was trying to stabilize above 111K. Within hours, that support gave way. Bitcoin slipped toward 110K, Ethereum dropped over 3%, and risk assets across the board turned red. This isn't just macro noise. It's a reminder that crypto doesn't trade in isolation anymore. Every tariff threat shakes liquidity and risk appetite. When traditional markets wobble, leveraged crypto traders tend to blink first. Analysts at Matrixport said today that the market's reaction shows how tightly Bitcoin is now tied to broader geopolitical flows. Meanwhile, traders on Binance and Coinbase reported heavier US sell-side pressure through the New York session. So while headlines might sound political, for crypto, they translate directly into volatility. And today's price action was proof of that. The macro bounce we talked about earlier in the week rolled over as US-China tensions escalated again. The US government announced one of the largest Bitcoin seizures on record connected to a global pig butchering scam. The UK moved to formalize compensation for victims in a separate multi-billion-dollar Bitcoin fraud tied back to China. And the Bank of England flagged that stablecoin caps will only lift when they're certain there's no threat to financial stability. It's a lot, so let's go piece by piece. First, the market turn. We had that nice little rebound, a bit of relief, but it didn't stick. Tariff talk picked up again, shipping fees and retaliation headlines drove the tone, and crypto did the usual thing it does when geopolitics heats up. It flinched first. Bitcoin was knocked down as low as roughly 110,000 before clawing back a bit. ETH's drop was steeper in percentage terms. If you're watching order books, you saw the same pattern on most majors. Bids stepped back, spreads widened, and shorts got braver into the afternoon US session. This wasn't about one exchange glitching. It was the classic 1-2 punch of headline shock on top of a market that was still rebuilding its confidence after the big wipeout. Thin liquidity in spots, stops a little too tight, and plenty of traders trying to be first through the same door. What matters is how it reversed the prior day's optimism. You could feel the switch flip, from maybe this rally has legs, back to don't get cute while the grown-ups are saber-rattling. We've said this before, but it's worth repeating. When geopolitics gets choppy, the first thing to go is leverage tolerance. You see it immediately in perps funding drifting toward neutral or negative. You see it in the size of the bids that actually sit rather than flicker, and you see it in how quickly alts move as a pack. Today, fit that playbook. The good news is that the lows didn't cascade. The market found its feet, just lower and more cautious. If you're trading, you respect the tape. If you're investing, you zoom out and remember that macro noise cuts both ways and tends to overswing. Now to the headline that will be echoed for weeks. The U.S. Justice Department announced charges against Chen Zhi, a Cambodian executive, and seized more than $14 billion worth of Bitcoin tied to a sprawling online fraud network. The allegations are grim. Forced labor compounds, trafficked workers coerced into running romance and investment scams, the pig-butchering playbook at industrial scale. The money trails ran through shell companies, luxury goods, and a global web of wallets. The U.S. coordinated with the U.K. on sanctions, labeling the organization a transnational criminal outfit. And it's one of the biggest single announcements of seized Bitcoin we've ever seen. You can paint this a few ways, but the picture is the same. Crypto has reached a stage where nation-states run investigations on-chain, coordinate sanctions across borders, and seize coins in bulk as part of transnational crime cases. 10 years ago, that sentence would have sounded like science fiction. Traders always ask the same follow-up. Will those coins hit the market? Not today. Seizure isn't sale, and these cases take time. Sometimes seized coins sit in cold storage for months or years until the legal process runs its course. Sometimes they're auctioned in carefully controlled tranches. Sometimes they move under custody arrangements that keep them out of exchange hot wallets entirely. The detail that matters for price is flow, not headlines. You watch where those addresses route next, and whether they ever hit a cluster that's tied to a sell venue. Until then, it's ambient risk, not immediate supply. Over in London, a different story with a similar thread. What do you do with seized Bitcoin tied to massive fraud? UK prosecutors are moving toward a compensation framework for victims in one of the largest China-linked Bitcoin fraud cases ever tried in Britain. The number floating today is about $6.8 billion worth of Bitcoin to be confiscated with victim payback the intent. That's huge. Not just for the victims, but for the precedent. Using seized digital assets to compensate those who were defrauded at scale in a cross-border crime is a strong signal that the system is catching up to on-chain reality. Instead of sell it and sweep the cash into the general pot, this suggests a path to restitution that meets victims where the harm actually occurred, in crypto, not just on paper. It also raises a thorny question for the market. If governments increasingly route seized crypto toward compensation, how does that change the supply picture? On the one hand, it's still net supply returning to market when victims sell. On the other hand, it's often distributed over time and to a much wider range of recipients, which can reduce the shock factor of a single auction. Policy aside, it adds another layer to how you think about supply overhangs. Not all government wallets are the same. Some are evidence lockers. Some are pipelines to auction venues. And some, increasingly, may be pathways to direct or staged restitution. While we're in the UK, there's one more Today story worth clocking. The Bank of England signaled it will only lift planned stablecoin caps when it's confident there's no threat to financial stability. That won't surprise anyone who has watched the BOE's style. Cautious, conservative, incremental. But for stablecoin issuers and for exchanges who depend on deep sterling liquidity, it's a reminder that this part of the market still lives under a microscope. The central bank is effectively saying, you can scale when we're sure you can't break anything. For listeners, translate that as, if you run a business that depends on seamless fiat to crypto flows in the UK, keep your redundancy plans sharp and your banking relationships diversified. Caps can lift, but caps can also come back if something hiccups. Pulling the threads together, what does today actually tell us? First, macro still rules the short term. One headline, one tariff, one retaliatory measure, and risk assets move in sympathy. Second, nation-states are not only watching the chain, they're using it to investigate, to coordinate, to seize, and potentially to compensate. Third, central banks and regulators remain cautious on the plumbing. Tokenization and custody get the nod, but stablecoin scale is prove-it territory until the grown-ups are satisfied. If you're thinking in weeks, you trade the ranges and don't overstay your welcome. If you're thinking in years, you watch the rails being built and ignore the daily mood swings. Let's talk quickly about structure for tomorrow, because that's where your edge lives. On Bitcoin, the easy levels are the round numbers you've been watching. 110 on the downside as a psychological pivot, 113 to 114 as the first patch of supply, then 116 if buyers get brave again. On Ethereum, 4,000 is the magnet. Fall below and stay there, and you're right back to arguing about 3,900 support with a lot of noise in between. On the large caps, most are moving as a pack, which is what you expect on a risk-off day. Where it gets interesting is the outliers in relative strength. Tron holding fractionally better than the field. Chainlink losing a bit more, but trying to attract dip buyers into the US afternoon. Avalanche catching a couple of two-way bursts, but still heavy. None of that is directional gospel. It's just your tape read for tomorrow's open. As for the "does this change the thesis" question you always ask me after a red day, the answer is no. The long thesis lives and dies on rails and custody, on tokenized funds moving into the real economy, on stablecoin scale once central banks are satisfied the guardrails work, on ETFs doing their quiet, relentless job with creations and redemptions. None of that is undone by a tariff headline or a bad afternoon. It just rearranges the timing. Before we wrap, the same reminder I give every time volatility spikes. Protect your stack. Self-custody matters. Exchanges can pause withdrawals. APIs can misbehave. Liquidation engines don't care about your circumstances. If you hold anything material, keep it cold. Your future self will thank you for being boring today. We have left a link in the description if you need one. If this cut through the noise for you, hit follow and leave a 5-star rating. It really does help. Share this with someone who keeps asking what's going on, but never has time to read the tape. We'll be here again tomorrow, same time, same place, with the numbers that matter and the stories that actually move them. This is the Daily Crypto Roundup. We'll see you at the top.